stop what you're doing. Because what just happened to gold in March 2026 is the kind of thing they will be writing about in financial history books. Not the fun kind of history, the cautionary kind. Gold just posted its worst monthly performance since October 2008. Let that sink in. October 2008, the middle of the global financial crisis. The moment Lehman Brothers had just vaporized, markets were in freefall, and the entire world financial system looked like it was about to get turned off like a light switch. That was the last time gold had a month this bad. And here we are, 18 years later, staring at a 14% decline in a single month, from a peak of over $5,600 per ounce, all the way down to a low of $4,700 on March 24th. Over $1,500 per ounce of value, gone, in 30 days. So what the heck happened? And more importantly, what does April hold for you, for your portfolio, and for the metal that billions of people around the world still believe is the ultimate store of wealth? Buckle up, because the story is wild, it's complicated, and the ending? Nobody agrees on what it is. To understand the destruction of March 2026, you have to understand what happened in the 18 months before it. Gold had a year in 2025 that was nothing short of legendary. The metal finished 2025 up nearly 65%. 65% in a single year. That was gold's best annual performance since 1979, back when America was dealing with double-digit inflation, an oil embargo, and a hostage crisis. Last year, gold went from around $2,624 an ounce at the start of 2025 all the way to $4,533 by late December. Then January 2026 came along and said, hold my beer. Gold exploded to an all-time high of $5,195 per ounce. The whole world was piling in. Central banks were buying. ETFs were seeing massive inflows. U.S. funds alone pulled in $6 billion in a single month earlier this year. The narrative was ironclad. De-dollarization, fiscal deficits, geopolitical chaos, fading faith in paper assets. Every macro trend pointed to gold going to the moon. And then the Strait of Hormuz happened. On February 28th, U.S. and Israeli forces launched strikes on Iran. The conflict that markets had been quietly dreading suddenly arrived with full force. And here's where the story gets deeply, profoundly counterintuitive. In every war since World War II, the playbook was simple. Conflict breaks out, investors flee to safety, gold spikes, fear is good for gold. That is the oldest rule in the handbook. The playbook got torn up and set on fire. Yes, gold initially rallied, jumping from 5,296 to 5,123 in the immediate aftermath of the first strikes. The traditional reflex still fired. But then something unprecedented happened. Iran closed the Strait of Hormuz, the narrow waterway through which roughly 20% of the entire world's energy supply flows. And Brent crude oil exploded past $110 a barrel, then $115. And that's when the geopolitical paradox was born. Here's the brutal logic. Rising oil prices mean rising inflation. Rising inflation means the Federal Reserve cannot cut interest rates. Cannot cut, and might actually have to raise them. And here's the killer. Gold pays zero yield. Zero. In a world where Treasury yields are surging and the Fed is holding rates at 3.5 to 3.75% with the dot plot showing only one cut in all of 2026, if that, gold suddenly becomes an expensive thing to hold. Money markets are now pricing a 60% probability of a Fed rate hike later this year. A hike. Just 2 months ago, markets were expecting 2 cuts. That whiplash destroyed gold's momentum completely. The opportunity cost calculation flipped. Why hold gold when bonds are paying real yields? Why sit in a no-yield metal when inflation-fighting central bank policy is sending yields higher? The institutional money did the math and started walking toward the exit. What followed was not a correction. It was a liquidation. Gold recorded its sharpest weekly drop since 1983, down over 10% in a single week. Silver fell more than 15% in that same stretch. Leveraged long positions got wiped. The 50-day moving average got sliced through like it was nothing. The $5,000 level, which traders had called unbreakable support, cracked open in a matter of days. By March 24th, gold touched $497, the lowest it had been since November 2025. By the time March 30th rolled around, gold had clawed back to $4,141, up 1.1% on that final day as bargain hunters stepped in. But the monthly damage was already done, down over 14%, worst month since 2008. Now, here's where I have to be blunt with you, because a lot of people in this community are gold holders, and they deserve honesty, not cheerleading. If you bought gold at any point between late October 2025 and the end of January 2026, you are currently sitting on a loss. In some cases, a significant one. Someone who bought near the $5,595 all-time high in January is down roughly 19% on paper as of today. That's not comfortable. That's not fun. And if you use leverage, if you were in gold futures or margin-heavy ETFs, March was catastrophic. But here's the other side of that coin that you also need to hear. If you've been holding gold since early 2025 or before, you are still in profit, sometimes substantially. The 2025 bull run was so explosive that even after a 14% monthly crash, anyone who positioned correctly a year ago is still ahead of the game. The question is, are you a victim of March 2026 or a survivor of it? Here is where the disagreement gets almost violent among the experts. And I'm going to give you every side of this debate because you deserve the full picture. On March 30th, we saw the first real sign of life, a 1.1% bounce. Bargain hunters are sniffing around $4,097 like it was the most attractive entry point since late 2023. According to USA Gold, there is a growing dislocation between paper pricing and physical market tightness, meaning the financial futures markets are saying one thing, but the actual physical demand for gold bars and coins is running extremely hot. That divergence has historically been a setup for violent mean reversion to the upside. JP Morgan hasn't moved its target. They still see gold at $5,000 by the fourth quarter of 2026. Goldman Sachs is holding a $6,000 year-end forecast. BNP Paribas raised its 2026 average forecast by 27%, flagging $6,250 as probable. Wells Fargo has a $6,000 to $6,300 range for year-end. Not a single major institutional forecaster has capitulated. Not one has cut their target significantly. Their logic, the structural supports for gold are entirely intact. Central banks are still buying. The U.S. fiscal deficit is still enormous. De-dollarization is still happening. The Iran conflict itself creates a floor under geopolitical anxiety. And when, not if, the Fed eventually pivots, gold's next leg higher could be its most powerful yet. There are also key catalysts coming in April that could move the needle fast. The April 28 to 29 FOMC meeting is the next major policy checkpoint. If inflation data begins to cool, or if the labor market shows enough weakness, the Fed's tone could shift. And in gold markets, tone is everything. And now the uncomfortable truth that the gold bulls don't want to hear. The technical damage done to the gold chart in March is real. The 50-day moving average has been broken. The $5,000 psychological level is now resistance, not support. If gold cannot reclaim $4,150 convincingly in early April, the next support targets are $4,160 and then the critical 200-day moving average around $4,200. A sustained break below $4,200 would open the door to $3,500, a 25% decline from current levels, and a complete round trip of the entire 2025-2026 bull market. There's also a more philosophical concern being raised. Bloomberg Intelligence's Mike McGlone put it starkly. Gold's surge to multi-year extremes versus most moving averages may suggest the store of value has shifted to a speculative risk asset. In other words, gold has been so thoroughly owned by the momentum crowd that it now behaves like a speculative asset, not a safe haven. When the leveraged crowd panics, gold falls. When sentiment sours, gold falls. That's not what gold is supposed to do. And that behavioral shift is the most structurally bearish argument circulating on Wall Street right now. Add to that, the Iran conflict shows no signs of resolution. The Strait of Hormuz remains a pressure point. Oil above $150 is not going away quickly. The Fed has explicitly signaled that energy-driven inflation taxes make rate cuts impossible for the foreseeable future. EY Parthenon's chief economist Gregory Dacko has revised his baseline to just one rate cut in 2026, likely in December, and says it's entirely plausible that the Fed won't deliver any rate cuts this year. Carson Group's chief macro strategist went further, openly discussing the possibility of the Fed starting to talk about rate hikes later in 2026. In that environment, holding non-yielding gold is an expensive proposition. Everyday rates stay high, gold bleeds a little more. Let me zoom out for a second because I think the March 2026 crash teaches us something profound about how modern markets work. For generations, gold was the ultimate fear barometer. War breaks out, buy gold. Crisis arrives, buy gold. That relationship was so reliable, so deeply wired into investor psychology that it became dogma. March 2026 broke the dogma. What we learned is this. In a world of $115 oil and 4% treasury yields, even war cannot save gold if that war causes inflation, because inflation forces central banks to tighten. Tightening raises the opportunity cost of holding non-yielding assets. And suddenly, the fear trade runs into the rate trade head-on. The fear trade lost. That doesn't mean gold is dead, far from it. The structural bull case, central bank buying, fiscal excess, de-dollarization, long-term currency debasement, these forces don't disappear because of a bad month. Axis Mutual Funds Analysis put it well. Gold's 2025 rally was built on trust. The 2026 sell-off was driven by fear, and eventually, trust tends to return. But the lesson for every investor watching this is that even the most sacred asset classes have new rules in a new macro environment. The playbook has been rewritten. So here's where I land on all of this. And I want to be clear, this is analysis, not financial advice. You make your own decisions. Gold had its worst month since 2008. That is not a punchline. That is a warning, a reset, and potentially, depending on how April plays out, one of the most significant entry opportunities of the decade. If the Iran conflict begins to de-escalate, if oil pulls back, and if the Fed signals any softening in tone at the April meeting, the structural buyers will come back with force. The institutions with $5,000, $6,000 price targets are not stupid. They are playing a longer game than one brutal month. But if oil stays above $115, if inflation reaccelerates, and if the Fed starts discussing rate hikes instead of cuts, then we have not seen the bottom yet. Not even close. April 2026 is not just another month for gold. It is the verdict on whether the greatest bull run in a generation was a sustainable revaluation or the biggest speculative bubble the precious metals market has ever seen. The jury is deliberating right now. I will be here when the verdict comes in. If you found this valuable, hit subscribe. Drop a comment below. Are you buying the dip, holding, or running? I genuinely want to know what you are thinking. And if you know someone who holds gold and has no idea what just happened to them in March, do them a favor. Share this video, because understanding what happened is the first step to surviving what comes next. See you in April.